We've had some interesting inflation data from the Euro area and the US this morning, both of which seem to point to the fact that policymakers at the US Federal Reserve and the European Central Bank will have to change course on their hawkish tone, either at the December meetings in a couple of weeks' time or early in 2024. First, let's take a look at that data. We see that the Euro area numbers this morning were not just close to the ECB's target of 2%. You can see the Harmonized Index of Consumer Prices, that's the preferred inflation measure, HICP. That rose by 2.4% in November. That's down from 2.9% previously and well below the consensus 2.7%. But on a core basis too, we also saw a 0.6 decline to 3.6%. And again, far below the consensus 3.9% too. So much steeper declines and much closer to the ECB's target. At the US level, we saw headline inflation was 3%. That was in line with expectations. And the core number as well was 3.5%, also in line with expectations. But again, in both cases, moving in the right direction and not too far from the 2% target. The most interesting part of this was probably the monthly reading of the PCE number. So that's, again, the Fed's preferred measure of inflation is PCE. And that was 0% on the month. So clearly representing an ongoing slowdown in the data. I think last month's 0.4% was a bit more of a blip in the data. But more broadly speaking, we have been seeing it gradually slow down in the second half of this year. And if that trend can continue into the end of the year going into 2024, then it's going to be very difficult for policymakers to maintain the hawkish tone and push back against interest rate talk, both in the markets, but also in the meetings as well. And all of this data over the last couple of months, in particular today on the Euro area side, has had a profound impact on inflation and interest rate expectations. And now, as you can see, the ECB is expected to cut rates in the markets by April of next year, so just 4 months away. That means we're going to have to see a change in tone and forecasts from the European Central Bank at that meeting in 2 weeks' time, if that is going to be enacted upon. And no, we've said on a number of occasions that I'm of the belief that we'll see a late pivot from the central bank, but we can't go from the hawkish narrative that we've had over the course of the last few months straight to a rate cut. There needs to be some period in between where there has to be at least a more balanced approach and a more neutral tone from the central bank. So that is surely going to now come at the December meeting if there is any chance of that April rate cut occurring. And based on the recent trend in the data, you would say that's perfectly plausible. Then we look at the US, and May to June time is when markets now expect that first rate cut too. Of course, these forecasts are constantly changing, but at this point in time, that is when the Federal Reserve is expected to cut interest rates. And again, we are going to have to see a substantial change in the narrative on that sense. Also, we saw it a little earlier in the week from one Fed policymaker, Waller, who's deemed to be at the more hawkish end of the scale, but it was non-committal. It was a case of if we continue to see disinflation, then in 3, 4, 5 months' time, sure, then we'll be discussing interest rate cuts. But effectively, at this point in time, we haven't seen enough of it. But it seems that we're not just heading in the right direction, but we're getting very close to target now. So I do think rate cuts are going to have to be on the agenda, or at least a conversation about when rate cuts can begin will have to be on the agenda when both the ECB and the Federal Reserve meet in 2 weeks' time on the 13th and 14th of December. And with that, we'll take a look at a chart. So here we have the euro dollar. And if you remember, we've spoken about this pair on a number of occasions before. And what was interesting about it quite recently was the fact that we had this downtrend earlier on and a rising channel. Now, at times that looked like it could potentially be a bearish pattern, a bearish flag formation. There was two things that really went against that, though. One was the steepness of the decline, which wasn't particularly steep. And the other was the fact that we saw more than 20 candles within this flag, which suggested that this is a trend that was weakening rather than strengthening, making a break lower less and less likely. And what we actually got in the end was a break through the top of that rising channel. After that, the key areas to focus on are pretty obvious in this. The moving averages on my chart was the first test, and we saw it burst through that quite quickly. And then it was a case of the Fibonacci zones for me, and that's from the previous highs here back in July through to the October lows. And again, the 50 fib caused a little bit of a stall, but then we broke through there. We saw some support and resistance between the 50 and 61.8 then in the period that followed. But the fact that the 61.8 was quite close to 110 really did just kind of broaden that spectrum in terms of where we could potentially run into resistance. We know that these psychological support and resistance zones can be impactful. And the fact that we did see it run in such strong resistance at that 110 level just around here does suggest that the markets were paying very close attention to it. What's more, we also saw signs of divergences forming on the MACD and the stochastic below. So you can see as we were seeing higher highs in the price in this period here, in fact, the MACD histogram was already trending lower. The stochastic was also pointing a little lower too. And at the same time, while the price was moving higher and testing that 110 level, and you can see the higher highs we were making here, we were seeing signs of divergence between that and the momentum indicators at the below. You can see that the histogram here on the MACD was already trending lower. We were seeing a flattening in the moving averages too, but also on the stochastic, you could see that this was starting to trend lower as well. So you can see quite clearly here that divergence was forming around the 110 level. So this was always going to be a big test of resistance. That doesn't mean that we were necessarily going to not see a breakout higher, and we could still see that breakout higher, and we could see momentum generated once more. But the fact that we are starting to see it run into a little bit of resistance around 110, which falls close to that 61.8 fib level, and we're seeing a loss of momentum, does suggest that we are just seeing this as a bit of an exhausted trend. And it will be interesting to see if we do see another move higher, whether we break through those previous highs that we saw yesterday, or whether it even potentially falls a little short again. Another sign of potential trend exhaustion here. There's still plenty of data to come over the course of the next couple of weeks, which will undoubtedly influence that too. But I just think that today's inflation data from both the Eurozone and the US was extremely telling. And now there's a lot of pressure on the central banks over the course of the next couple of weeks going into that meeting in terms of its communication, particularly on the Eurozone side with the Fed blackout period actually beginning this weekend, but also on the data as well to justify a change in tone from the central banks. The most obvious data points that stand out now is the NFP on the 8th of December and the jobs report as a whole, of course, and then also the US inflation data, which is actually released one day prior to the Fed meeting itself. So there'll be a lot of anticipation in the build up to that meeting, but it does seem that the ground is now set for a change in tone because inflation is coming down and is now not far from target.